This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance, Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Fed hawk Christopher Waller says he favors a quarter-point hike at the next meeting, while Klaas Knot here in Europe sees at least two more 50 basis point increases for the ECB. JP Morgan sees chances of an economic downturn falling across markets. The dollar drops with European stocks trading higher. Plus, Olaf Scholz and Emmanuel Macron warn European businesses will need to dramatically boost spending to keep pace with the U.S. and China. Now, first thing is first, so let's check on the markets. We are probably going to see thinner volumes than usual because of the Chinese Lunar Year, so a lot of financial centers in Asia will be closed. European stocks pretty much unchanged, maybe gaining 0.2%. We're seeing energy, of course, one of the biggest gainers in today's trading session. The dollar index, 1,222. If you look at euro dollar, that's probably the most interesting currency. This, of course, is on the back of some of the differentials when it comes to interest rates. The dollar actually slipping. Stocks, though, are gaining after we had a lot of Fed speakers maybe sounding a little bit more dovish than usual. Let's also get to the European map. Again, there's not a huge divergence of the fortunes of some of these European stocks. The FTSE MIB down 0.2%. Juventus, I know it's a penny stock, but it's down some 10% after it lost quite a lot of points because of accounting irregularities. The picture for the FTSE getting 0.2%. So there has been muted trading in Asia. Many markets closed, as we were saying, for the Lunar New Year. So that's the very latest on what we're seeing. However, Japan stocks did close up. Prospects for slower policy tightening by the Fed lifted investor sentiment. Now, for more on all of this, we're joined by Luke Hickmore. He's investment director at ABRDN. Luke, good morning. Happy Monday. What's the week looking like?
Difficult, I think. It's easy to get sucked into these equity rallies and bond rallies that we've been seeing over the last few months. But we start seeing earnings season kick off in earnest this week. A lot of tech earnings coming out of the US as we go through the week. And I think that might temper some of the enthusiasm we've seen for risk over the last month, 2 months in particular.
So, Luke, talk to me a little bit about, what we've seen overall. When you look at some of the concerns out there, I don't know whether it's the market not understanding what the Fed will do and how aggressive it can be.
So, we've still got different Fed members telling you different things. The 25 basis points from one and 50 basis points from others. I think they are still keen to push those rates up and actually get the US economy into negative growth, possibly even recession over the next 6 months or 7 months. And the market seems to be kind of ignoring that a little bit and saying, look, we want to buy, there's lots of cash on the sidelines, let's get it involved, let's move on and, and actually get some growth going. But, the Fed's still there, it's still going to hike. Companies are going to find their earnings coming under increasing pressure as the year goes on. I sometimes think we forget that lower inflation does not mean lower prices. Consumers are still going to be finding the year pretty hard. And that all needs to come out, I think, over the next month or two to really reset the market to a much more better valuation level for the risks that we face going forward, whether those are inflation or interest rates or war risks still in Ukraine, of course.
Yeah. So, look, where do you see the most interesting part of the market? Is it currencies, or do you actually play some of the equities? I don't know if it's on the back of earnings or margin squeezes.
I'd be nervous chasing equities here. I think investment grade credit is probably a decent place to be, but even that short term feels a little bit expensive. And I'm an investment grade credit manager, so it's always easy for me to say my market's brilliant. But I think just short term, even that looks expensive, particularly in dollars and euros. A little bit better value maybe over in sterling, and you can find pockets of value out in the Far East, as we've seen with our emerging market teams. But even that needs to kind of correct a little bit to reflect the risks that recession really is coming, even though that seems to be fading off the radar a bit.
Luke, let's also bring in Heather Burke from our Bloomberg MLive team. Heather, good morning. Thank you so much for joining us. When you look at Klaas Knot and actually what's happening in the ECB, are we going to see more interest rate differentials? And what does that mean for currencies?
Definitely. On the one hand, you have the Fed, like Christopher Waller, saying, okay, we're 25 basis points look in. We're seeing some slowdown. Maybe that Fed pivot's coming. On the other hand, in Europe, in the euro area, you've had all these central bank speakers from Klaus Knott, Olli Rehn saying, okay, we are not where we need to be. We need to keep hiking. 50 basis points seems pretty baked in for the February 2nd meeting. And so, yeah, we are seeing this differential. At the same time, the euro area economy, still there's a lot of soft patches, but the energy crisis has eased. And, we're seeing maybe the worst case recession scenarios have been averted. That being said, the ECB doesn't want to take the foot off the gas. They want to put rates in restrictive territory.
Luke, what does that mean for your expectations of what the ECB can do? Again, there was a Bloomberg story, citing sources last week saying that we could see, the end of the 50 basis point hikes, but I don't know whether that deals with inflation the correct way.
It's not the only thing we've got to worry about with the ECB as well, of course. The 14 to 16 odd % that they own in the European corporate bond market needs to get unwound as well. So it's not just these rate hikes that we've got to get through. It's the QT that we're going to be seeing after that, and a massive amount of sovereign issuance that, close to 500 billion net by most people's estimates over the rest of the year from Europe as a whole. So, ECB's not just there on the horizon as the concern for investors in Europe. And I think, again, the euro seems to be running ahead of itself a little bit. The fall off in the dollar, in particular DXY, down to levels we saw last April, seems too far right now for those risks that we see going forward. And Heather, I love the MLive blog, by the way. Some great notes this morning on the euro.
So congratulations, take it. It is a wonderful blog. Heather, what are you focusing on next, actually, when it comes to currencies or even bonds in Europe?
I look at the whole story overall. You've had European outperformance. I'm a stocks geek, and you've really seen European stocks. They had one of the best quarters ever in dollar terms versus the S&P 500 in 4Q. You've seen that outperformance continue. I think part of that's the overall ECB, the hiking story, the economy and energy averting these worst case scenarios. I'm going to really be looking at earnings as a kind of make or break for stocks on both sides of the Atlantic. You had Symrise out today, a chemical company, and they've had some margin issues. They're down. And that is a really big banana peel for stocks on both sides of the Atlantic. The U.S. this week, we're going to start to see some of those big tech readings with Microsoft and Tesla, and that comes with a lot of job cuts. Are they going to kind of be able to produce the same kind of growth that kind of seems baked into some of these stocks?
Look, what do you do with a lot of the tech stocks and names?
I think it's tough. I think, you could look at this as a long-term opportunity to just ease in a bit of dollar cost averaging into what are some great names. But you want to be, I think, probably at the top of the pile, the quality names in that space, the Microsofts, the Google Alphabets, the Masks, those kind of businesses, rather than kind of chasing the smaller players in those markets who I think are going to find it really hard. I agree on the margin side completely. And, we are going into a season in Europe in particular where we're going to be talking about earnings, and we're going to be talking about bulk negotiation of wages across Germany in particular, which could be 10% this year. So, yeah, margins all year long.
Great. Thank you both for joining us. Luke Hickmore, their investment director at ABRDN, and Heather Berg from Bloomberg Markets Live. Now, this is a picture overall for, Salesforce. Hedge fund Elliott Investment Management has taken a substantial, and when I say substantial, I mean an activist stake in Salesforce, making it move after layoffs and a deep stock swoon at the enterprise software giant. Now, on the back of Elliott's investment, the stock price is gaining some 4%. Elliott, one of the most aggressive, actually activist shareholder, often pushing for strategic changes, often seeking board representation. We understand took a multi-billion-dollar stake in the company, and of course the market cap of Salesforce now $151 billion, down from a peak of more than $300 billion back in 2021. Coming up, European leaders fire off warnings over a huge U.S. green spending plan. We'll have more on that story next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, France and Germany are pushing for huge spending increases so European businesses can compete with U.S. and Chinese rivals. It does follow a summit between the French and German cabinets in Paris over the weekend.
Es ist notwendig, dass wir
It is necessary that we handle the inflation reduction aid and formulate a European answer. Firstly, we have to make sure that, as a European Union, we are not treated worse than neighboring countries such as Canada or Mexico. And it cannot be accepted that the many local content regulations that are in there cause discrimination of European businesses and their activities in the U.S.
Unternehmen bei ihren Tätigkeiten, Aktivitäten in den USA bedeuten.
Now, for more on all of this, we're joined by Bloomberg senior editor Benedict Kamel. Benny, thank you for joining us. So tell us a little bit more about what was actually discussed at the summit in Paris.
So the summit between Macron and Olaf Scholz, the German chancellor, in fact, the entire cabinet of Germany flew over to Paris for this. And one big topic was, how do you counter President Joe Biden's Inflation Reduction Act, the IRA, which is essentially a $500 billion sort of act to get future technologies, future energy off the ground, do more sort of for Buy American and create a huge counterweight to what's happening in Europe and what's happening in China. There is that concern, and we heard it just now from Olaf Scholz, saying we want to make sure there's a level playing field. We want to make sure that we're not treated any worse than the direct neighbors of the US, Mexico and Canada. But how do you do that? You can either go the official complaint route down the WTO. That'll probably take years, and it's unclear where it'll take you. And what they've now decided is they want to create something similar over here, a similar push that will keep companies here in Europe, because there is a concern that companies will look at what's happening in the US, they will move business over there, and during times of sort of economic difficulty, that's the last thing you want.
So, Benny, is this a sign that EU governments are moving towards more active involvement in companies?
It sounds that way, but it's unclear how exactly how would that shape out. Would it be a universal effort across Europe? Would it be country by country? We've already had a lot of sort of countries doing their own thing. In Germany, we had efforts to stabilize the energy sector, to stabilize the aviation sector, and so on during the pandemic, but also now during the energy crisis. And you want to make sure that not every country does its own little thing, but that there's a universal effort. So how exactly that'll work out, that is unclear. France and Germany being the two dominant economies coming together, that'll probably go a long way, but there's a lot of left unknown in the detail. There are further meetings planned today by the foreign ministers. There are meetings by the leaders in the next couple of weeks. So the intent is there, but how exactly that'll shape out and how you make sure that you don't hollow out the European competition laws, that remains unresolved.
Benny, thank you so much. Bloomberg's Benedict Kamel, they're joining us on this very latest summit. Now, Ken Griffin's Citadel made a record $16 billion in profit for clients last year, the largest ever return for a hedge fund. Well, joining us now is Bloomberg's markets reporter, Valliere Teitel. Valliere, I mean, the numbers are incredible. $16 billion in profit, $12 billion in fees. And it does seem like you're either Millennium or Citadel and have a very different strategy, and you're really killing it. Or you're like Rockhaus and Brevin Howard, and you did for bonds, and you also did very well.
Yeah, it's really all about this multi-manager model, which you mentioned a lot of these big hedge funds are running now, Citadel, D.E. Shaw, Millennium, which allowed them to return these just incredible numbers last year. You know, the multi-manager model allows them to have a wide range of strategies across different assets, and each of these teams have a niche focus and a specific trading style. And it allows, Citadel in this case, to allocate capital to within the fund to these specific styles which they think are going to be successful. Last year it was all about being exposed to movements in bonds and FX, and if you didn't have that in a big way in your portfolio, you were going to miss out. But, you know, this is all overlaid with a risk management approach that allows them to navigate from having specific blow-ups under one trader. It's diversified, and it's showing it's going to be the model for the industry. You know, it's really taken the baton from the equity long-short funds of the past. The tech bubble bursting really showed a lot of weaknesses in their model. And, you know, a further shift away from the single manager models of the past. It's no longer going to be
unless you're a macro. If you're a macro, if you're Bremen, Howard, and Rockos, then you've done also pretty well in shorting some of the bonds.
Yeah, those guys did extremely well last year. But the thing about that model, Francine, is their assets under management is in some way capped. Right? These multi-managers can have a huge array of assets. You know, Citadel runs over 60 billion, and it's hard to see that being run under one specific manager in a macro model.
Valliere, thank you so much. Valliere Teitel there, our Bloomberg Markets reporter. Coming up, a UK business group warns Rishi Sunak's government what he needs to focus on for green growth. So we'll dig into that story next. This is Bloomberg. So the UK's ruling Conservative Party has been told to stop fighting with itself over tax and prioritise green growth. Now, the warning shot has come from the Confederation of British Industry, a prominent business group. Well, joining us now is our UK correspondent, Lizzie Burden. Lizzie, first of all, tell us, good morning, tell us a little bit about this call by the CBI to push green investments in the UK.
Well, the US, of course, has got its Inflation Reduction Act. Last week, we heard from Brussels calling for unprecedented investment into clean tech. So this is the CBI telling Britain to step up to the plate. You've got Tony Danker in his speech this afternoon calling for deregulation and for state funding. And of course, he's not the first to call for it. You were in Davos last week. You spoke to the Shadow Chancellor, Rachel Reeves. She said, don't carp on the sidelines about what others are doing. Get on with it yourselves to the government. And in fact, a government-commissioned report by the former Tory Energy Minister, Chris Skidmore, earlier this month also said that net zero is the growth area of the 21st century, but it's the inertia at the moment that's holding back jobs and investment. And actually, the CBI's research today shows that by 2030, the UK will have lost the value of £4.3 billion in terms of battery production and hydrogen market share. So this is something of an international green arms race.
Lizzie, at the same time, it's cold. It's very, very cold. There's like this, you know, wave that we probably brought over from Davos here in the UK. Does it mean that we're going to use more coal?
Well, it might have done. Overnight, National Grid had asked for 3 coal-powered units to be fired up, to be put on standby, because you've got freezing temperatures and low wind power, so more demand and lower supply. But actually, National Grid has stood down the units. What's interesting, though, is that people are still going to be paid to reduce their consumption between the hours of 5 and 6, peak time. And so it shows that the UK is getting into line with the rest of Europe in terms of not just using supply-side policies, but also demand side.
Lizzie, thank you so much. Lizzie Burden there with the very latest on the UK. Now, we'll be covering all things UK every week on Thursdays at 9:30 a.m. in our half-an-hour UK special. Now, let's get straight to the Bloomberg First Word News. Here's Alice Atkins. Hi, Alice.
Hi, Francine. A top health official in China has suggested more than 1.1 billion people have been infected with COVID since virus controls were abruptly dismantled late last year. In the week leading up to this weekend's Lunar New Year holiday, Beijing's official death tally was about 12,500. The World Health Organization is urging China to release more detailed information on the outbreak. Germany's foreign minister has suggested it wouldn't stand in the way if Poland sent Leopard tanks to Ukraine. The German defence minister meanwhile acknowledged for the first time that Ukraine will need battle tanks to regain territory. This as former UK PM Boris Johnson travelled to Kyiv, urging the West to double down on support for Ukraine. Incoming New Zealand Prime Minister Chris Hipkins says he will prioritise the economy as a recession looms and may drop some of Jacinda Ardern's policies. Hipkins is seeking to win back the political middle ground ahead of an October election, with his Labour government trailing in opinion polls. He says he's heard the messages from some voters that the government is doing too much, too fast. California police say a man who killed 10 people on Saturday night at a ballroom dance club east of Los Angeles killed himself as officers closed in. 10 other people were wounded in the shooting in Monterey Park following a Lunar New Year celebration. Armed officers surrounded a white van about 50 kilometers from the scene of the attack before the suspect shot himself inside the vehicle. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine?
Alice, thank you so much. Juventus Football Club actually falling some 12% just now. This is on the back of, Italy saying that they will take about 15 points away from the club, and this is because of alleged financial manipulation or how they accounted for player transfers. Coming up, millions mark Lunar New Year across Asia as the region celebrates a holiday without COVID restrictions, so we'll have plenty more on that next. And this is Bloomberg. Fed hawk Christopher Waller says he favors a quarter-point hike at the next meeting, while Klaas Knot sees at least 2 more 50 basis point increases from the ECB. JP Morgan sees chances of an economic downturn falling across markets. The dollar drops with European stocks trading higher. Plus, Olaf Scholz and Emmanuel Macron warn European businesses will need to dramatically boost spending to keep pace with the US and China. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, for the first time in years, millions of people have been able to travel across Asia to celebrate Lunar New Year without restrictive COVID rules. China's abandonment of its zero-COVID policy has given the travel sector a boost, while also raising concerns it could lead to a spike in cases across the region. Well, joining us now is Kailey Jin, Associate Professor of Economics at the London School of Economics. Kailey, as always, thank you so much for coming on. How do you see the China reopening going?
Well, it's a tricky time. It's one for festive seasons, and the forbidden fruit consumed in Beijing with fireworks blasting off indicates one thing, that some people are ready to move on, to invite, to welcome a new cycle of renewal. On the other hand, there are costs of economic reopening for practically every family. So it is a tricky time, but people are looking forward.
So, can you talk to me a little bit, and what you're extremely good at is really looking at the nuances of reopenings, what this means for urban China, what this means for rural China. Are we going to see many divergences?
Look, in China, there's currently right now not only pent-up demand for consumer spending, but also a pent-up determination for everybody, whether it's the government, the companies, the households, urban areas, rural areas, ready to welcome really a new beginning after years of prolonged lockdowns and economic downturns. The urban inequality and rural inequality has widened because of the pandemic, but government fiscal spending, fiscal expansion, which will be a focal point for policymakers, are also aimed at rebuilding household balance sheets and supporting especially those who have been hurt during the pandemic, and that includes rural households.
So, Kayu, what does pent-up demand look like? Is it goods first? Is it luxury goods and then on to services?
Well, the Chinese consumers respond slightly differently from the, let's say, consumers in other countries. With reopening, they have built up a lot of saving over the pandemic, but they're not going to just go out and spend on large durables and large amount of spending, because it's a lot of precautionary saving. There's still a lot of uncertainty in the Chinese economy. Confidence has to rebuild. But in the short term, I can assure you that all families are looking forward to go out there, spend on discretionary services, travel again, and short-term spending will be up. But there is long-term or longer structural problems, structural issues in the economy. It's not as if we just open up the economy that all of the economic woes in China would be solved. You have the large, debt issues, debt overhang, the fact that companies, those who are still surviving, because billions of them have gone bust over that cycle, look at, how do they rebuild their businesses, and the fact is the economy is not really like what it was 10 years ago for China anymore. It's not easy to stimulate the economy as it was when the property was thriving. So these stimulus policies don't work as effectively. There are significant headwinds despite the short-term boost.
So can you give me a sense of what that means actually for some of the policies put in place going forward? So we know that also the economy, policymakers, even the central bank has tried to support the economy. Will that be the main story for 2023 as well?
Well, it's a delicate balance because we need to think about financial fragility as well, and that's on the minds of the Chinese government. How do you, all eyes are now focused on growth. Yes, but once there is significant pickup, they have to turn to maintaining the financial system problems and financial fragility. So I think there's a lot of room for fiscal capacity. There's also more of a lax monetary environment. But again, once the economy normalizes, we can also expect interest rate hikes again, whether it's to fight off potential inflation or to preserve the financial system. So it's a tricky balance. But everybody is aligned to refocus on the economy. And that goes to show that pragmatism and legitimacy ultimately go hand in hand.
Thank you, Kailey. Let's also bring Diana Troileva, Chief Economist at Inodo Economics. Diana, we're just talking there with Kailey Jin about what kind of economy, I guess, China will see in the next 12 to 18 months. What's growth looking like, Diana?
Well, first, let's see how we get through the Chinese New Year and this largest human migration, which will spread another wave of COVID infections across rural areas where the population is less protected for a variety of reasons. Beyond that, the authorities are intent on getting the economy going from the spring onwards, and very much using the old model, if you'd like, credit-fueled, investment-driven expansion. There is some pent-up consumer demand. However, consumer spending has been in the doldrums for a variety of reasons, and reopening or the very strict lockdown restrictions were not necessarily the main one. So over the long term, growth is highly unlikely to reach the pre-pandemic rates. But in the very short term, if we go through this next couple of months all right, and the Chinese Communist Party's gamble pays off in terms of the abrupt and unprepared opening up, then we are looking actually at quite a significant short-term upswing.
So, Kay, and thank you, Diana. We'll come back to, of course, this idea of how the economy also changes. Kay, you're in Beijing. How is travel actually looking like? So we understand there are no restrictions. Is everyone going back home? Certainly, there'll be more people going back home than 2022. Do you worry about, the COVID situation?
I look out my window and I just see traffic everywhere, traffic like we've never seen before for years. And the airports are full, and people have just said, look, it's been 3 years since I went home to the rural areas or wherever. Everybody's going around. And there's a sense, at least in urban areas, that this wave of pandemic is over. So let's try to enjoy the freedom while we can, and we'll worry about the second wave later. So I do sense that there's this excitement, there's willingness to go out, but work and rebuild and spend. But, we don't know when the next wave is coming, but hopefully the country will be more prepared and there will be less psychological trauma the second time around.
Diana, what can you tell us about soaring unemployment and, maybe concerns about the income outlook?
Look, clearly, the lockdown sort of zero or dynamic zero COVID policy had driven the economy into the ground. One particular worry is the high rate of unemployment, in particular among the young, those between 16 and 24 years. And this is a key challenge for the party. They have been actually battling with it for the past over a couple of years, including all sorts of measures along the lines of pressurizing state companies to hire interns, even unpaid interns, just to help out with that problem across the younger generation, who are also the ones that kick-started the protests in November, which were largely a surprise to the authorities, even though they managed to get a handle on them very swiftly.
And, you know, given all of that, we did see, as I think you were saying, you know, Chinese leaders making domestic demand a priority. There have been analysts that have been calling for cash handouts, like we maybe saw in the U.S., to support, you know, some of the policies that they've already put in place. What do you think government support looks like from here until the end of the year?
Well, one of the key differences between Chinese policy response.
Sorry. Let's do KU first, and then Diana, I'll ask you the same question.
One of the first responses, the key differences between the Chinese and the Western government was that the Chinese focused on supporting the firms in the beginning of the pandemic and not necessarily the households. And now we see a large deterioration of household balance sheet as well, and a large amount of, you know, a large number of unemployment and precautionary saving, as we mentioned. Now the focus is back on consumers and household welfare. So a lot of the fiscal policy should be, and I think will be, directed towards supporting households, but at the same time giving firms, small and medium-sized companies also a boost as well.
Thank you, KU. Diana?
That is very much the case in terms of what the authorities are trying to achieve. But of course, they don't have full control of households who, for a variety of reasons that continue to be salient, have this higher precautionary saving desire. So in order to get quickly the economy off the ground, there is a huge fiscal boost aimed at infrastructure spending as well. More generally, I would argue that removing the dynamic zero COVID has removed what was a short-term constraint on people's ability to simply go out and shop, and of course the psychological impact of the huge uncertainty, which is likely to continue to cause precautionary saving even after the change in the authorities' pandemic measures. And also, China has not reversed in any shape or form its common prosperity idea, this redistribution of income and wealth, you know, from the rich towards the poor, which is a key reason why the well-off urbanites are not out spending in droves.
Yep. We'll have plenty more, of course, on China throughout the day and the week. Thank you both for joining us. KU Jain, Associate Professor of Economics at the LSE, and Diana Choi-Leva, Chief Economist at Enodo Economics. Coming up is the bankruptcy of Genesis, one more blow than the crypto lending industry can withstand. We'll get more of that next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now, crypto lending firm Genesis has filed for bankruptcy, becoming the latest to collapse in the aftermath of FTX's swift downfall and last year's rout in digital assets. Is the news the final nail in the coffin for crypto lending? Well, we're now joined by Matteo Dante Peruccio, President International of the digital asset manager Wave Financial. Matteo, thank you so much for joining us. Who's next? Is there a concern that it will take 5-6 more months, if not more, to work our way around this?
Well, thanks, Francine, for having me. And it's nice to hear someone pronounce my name correctly. Thank you. Yeah, I think, look, I've been a pretty strong advocate for the fact that this is a young industry, and we're going to see, I think, more of this before it's over. But I don't think the terminology of nail in the coffin is the right way to look at this. I think this is a necessary phase for a young industry to go through in order to exit and emerge in a more healthy environment with a sort of a flight to quality. The better players, the more risks managed operators will end up taking over a lot of these distressed players, and I think we'll see a stronger industry emerge from all of this.
But Matteo, what needs to happen for that to be true? We're still seeing a lot of regulators and regulatory bodies not wanting to touch crypto until that's being taken care of. How can you be sure, where the end is, or at least where we're not going to see more bankruptcies or people going under?
Well, it's a great question, but I think we need to contextualize it and make sure that we remember this is today a $1 trillion industry. Despite all of the headwinds that we've seen, I don't know of many other industries that would survive so much onslaught as we've seen in the digital asset space. At the same time, I think we have a situation where we have the regulators now paying attention. My hope is that we'll see thoughtful and prudent regulation and not punitive regulation. That's always the risk. Obviously, as more of this plays out, we'll see what's behind the whole Genesis, DCG situation. Let's see. But I'm really an optimist. I see more and more. I certainly here in Europe. I'm in Europe, and I see the regulators becoming much more proactive. We have the European community putting in place legislation. We see in MENA, Dubai in particular, leading the way, with Bahrain also putting in legislation. So I think with that regulatory clarity, I think that's going to bring a lot more institutional interest, because once institutionals know how this will be treated, how it'll be taxed, and considered from a legal perspective, there'll be a greater degree of eagerness to enter into this sector.
But Matteo, how big do you see the crypto crackdown, right, in the next 2 to 3 years? Again, there have been concerns, rightly or wrongly, about money laundering, about tax evasion, about fraud. Some of these concerns, is that what regulations need to tackle first?
Yeah, I think what makes this all a little bit uncharted territory is that, as far as I'm aware, in my 35 years in investment management, I'm not really familiar with many financial innovations that started at the retail level and have worked their way up the, let's call it the financial food chain, to the institutional. So I think, the regulators are very much focused on the retail end of this, ensuring that retail, and unfortunately, retail investors have been hurt in some of these things, like the Genesis and the Gemini Earn program and so on and so forth, Voyager and others, Celsius. But I think I really do believe that the regulators will focus on that aspect of it, and I'm actually more bullish on seeing this develop into the institutional, what I call the individual, the wealth management space, where this is a very interesting market and segment and asset class, and I think all investors should and will eventually have a degree of exposure to digital assets.
Who, Matteo, do you think will survive this? And again, Genesis differed from a lot of the peers because they didn't market directly to individuals. It's almost like a fund of funds.
Yeah, I mean, that's a very, very good question.
Tough question.
Who will survive?
Yeah.
I don't think we've seen, I'm reluctant to make any prognosis, because we've seen things that we would never have expected to see. So that's it's a pretty difficult prognosis to make. I can tell you the type of players that will survive this will be the prudent, risk-managed entities, and I do see a flight to let's say a reawakening of the importance of experience, of knowledge, of risk management capabilities, and there's some of those more traditional skill sets that maybe perhaps in the past were undervalued in the digital asset space.
Okay, thank you so much, Matteo, for joining us. Matteo Dante Peruccio, President International of the digital asset manager Wave Financial, joining us this morning. Now, coming up, Bloomberg has also learned that an activist hedge fund has taken a big stake in Salesforce. So we'll bring you that scoop next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we're just getting some breaking news from the Bundesbank chief. He is Mr. Nagel, saying that the ECB will return inflation to the target without causing a recession. We have had a number of central bankers, including Klaas Knot, giving, of course, media interviews in Davos and then again yesterday. And we've also had the French line. So it's unclear at the moment whether they'll be quite aggressive in further rate hikes or whether they're very data dependent. But we'll watch euro dollar for the moment 109.17. Now, activist investor Elliott Management says it has made a substantial investment in software giant Salesforce. Bloomberg understands the stake is worth a multi-billion-dollar sum. The investor is known for seeking board representation and pushing for strategic changes. Well, joining us now is our Bloomberg technology reporter Aggie Cantrell. Aggie, great to speak to you. So what's the background to Elliott's stake? Why now?
So the background to it is essentially that Salesforce is one of the many parts of the tech sector that was really a pandemic darling. We saw the market cap go up to $300 billion in 2021, and now it's around half of that. So the question is Salesforce, while a company that has performed extremely well during the pandemic, how can it maintain that organic growth going forward? And even if it is still performing better than some of its competitors like SAP and Oracle, Elliott coming on board is probably more of a question of how to make sure that there is a good return on investment going forward for the company's investors.
So should Salesforce be worried? I mean, Elliott, I guess by reputation, is one of the most aggressive shareholders, activist shareholders.
Yes, so there has been worry over these sort of things in the past, especially when Elliott comes on board. But the difference is here is that we've already heard that he's very bullish on the CEO at Salesforce, sees him as a steady hand at the company. And that's going to be crucial going forward. We have seen 5 top executives leave Salesforce since September, including the co-CEO and the founder of Slack, who was brought on board when the company purchased Slack. And so what we're expecting to see going forward is potentially encouragement for potential share buybacks. And also, we are not likely to see Salesforce engage in any of these major acquisitions that they did with Slack a couple of years ago.
All right, Aggie, thank you so much. Our Bloomberg technology reporter, Aggie Cantrell, there in Berlin. Now, we'll have plenty more, of course, on this story throughout the day. Bloomberg Surveillance Early Edition continues in the next hour. Now, this is a picture overall, not only for technology, but for equities are seeing a little bit of a rise. Euro dollar, we just looked at it a couple of minutes ago on the back of the Bundesbank governor, the chief, saying that they will return inflation to target without causing a recession. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz are in New York. Anna Edwards is here in London, and this is Bloomberg.
The direction, I think, is a good one. Inflation is still well above the Fed's target.
This battle, so to say, is not won yet. And I think central banks are probably right, and that has been our view, to warn markets not to get ahead of themselves.
We still have a considerable way to go to our 2% goal, and I expect to continue tightening policy past this meeting.
It looks like we'll have to be a little more patient to see if we're on the right trend.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Citadel's record-breaking year. Ken Griffin's hedge fund churned out $16 billion in profit for clients in 2022, the most ever. Elliott Management takes advantage of tough times at Salesforce. It's taken an activist stake at the company hit by job cuts and a plunging stock price. And more classified documents found at President Biden's home in Delaware. That comes after a 12-hour search by FBI agents. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, of course, many markets over in Asia closed for the Lunar New Year celebrations. Elsewhere, we are focused on central bank hikes, I suppose, on either side of the Atlantic, but celebration time in much of Asia.
Yeah, and for that reason, it was a really quiet day overnight. You had markets closed in China, Hong Kong, Taiwan, South Korea, and many others. So, Matt, I'm not going to do a check of the Asian markets today because really the only market that was trading was Japan. Stocks there were higher, but of course, we're going to get a little more action here in the U.S. today.
Yeah, well, hopefully. I mean, right now, there's a whole lot of nothing going on. S&P futures are unchanged right now. We had a pretty mega rally on Friday, up almost 2% on the S&P 500 in the cash trade. So maybe investors are waiting to see which direction the wind is blowing to kick off this week. It's the first long week in a few. We do have some moves in the 10-year yield, but very little there as well. 348 is the level here. Maybe the dollar I should have put in here because it's going to be interesting to see, as Anna mentioned, central bank moves, how that euro dollar moves, since the U.S. maybe is going to slow down its pace of rate hikes, and Europe maybe is going to keep going 50 if you listen to Klaus Knott. We're going to talk about that throughout the program. NYMEX crude right now at 81.88, so back up over $80 a barrel for West Texas Intermediate. We also see Brent climbing this morning. And then speaking of a climb, Bitcoin now up to almost $23,000, $22,782. So way back above the pre-FTX level, and seemingly not deterred by the Genesis bankruptcy. Bitcoin continues to rise. Anna, what do you see in Europe?
Yeah, some real resilience there in terms of the crypto story. This is what we see in Europe, a little bit of resilience in that we are making very modest gains across Europe, up 1/8% or so on the German market, on the UK market, really just trying to catch up with what we missed out on stateside, I suppose, during Friday's session. In terms of the focus, Matt mentioned what's happening with Klaus Knott and what he's been saying at the ECB, and that is really the heart of what's been driving things here in Europe. I can show you what's been going on with the euro dollar. We've seen euro strength, and in fact 4 days of euro strength, going above 109 for the first time since April, and we are above 109 still, so we've been sort of flirting with that line through much of this morning's session. But this after a number of hawkish voices last week were pointing in this direction and pushing back against earlier reporting that suggested that maybe there'd be some sort of dovish step down in the hike levels. So the euro responding to that hawkish commentary and up by 0.5%. Juventus, this is an Italian football club in the Serie A league over in Italy, and they have lost 15 points in their standings, and this is as a result of the way that they treat transfers, the accounting treatment of transfers. They've been found to have breached some rules there. They are appealing it. They deny any wrongdoing, but for the moment, it seems to have ruled them out of European championships, and that is having a negative impact on their share price. Symrise, this is German chemicals, and this is a business that reported some numbers after the close on Friday, and the margin looked to be light of what was expected, and so a bit of a clue perhaps what's to come from some of the industrials here in Europe. That stock getting a negative reception, and natural gas prices really in focus. A real cold spell hitting Europe right now. The focus in the UK is very much on whether we're going to need coal resources switched back in. We seem to have avoided the need to do that over Monday night. Those resources had previously put on standby and now have been stood down. But the overall focus in Europe is very much on whether we'll continue to see this downward move in gas prices despite the cold weather, Kailey.
Yeah, interesting to see the gas prices moving the way you would expect opposite now that cold weather has finally come for Europe in the UK. Now, let's turn to a big figure, $16 billion. That is how much Ken Griffin's Citadel made in a record year for profit for clients, the largest ever return for a hedge fund, and that was in 2022. Joining us now is Bloomberg Markets reporter Valliere Teitel. Valliere, how did Citadel pull this off?
Look, Kailey, it's not about a single trader or a single trade, but it's really about this multi-strategy, multi-manager model that Citadel's running, which really consolidates all of these top traders under one fund, and each of these traders have their specific niche, their specific focus, and the risk management strategy that they run allows them to give capital to these funds that are doing well and pull capital back from these trading styles, from these managers who aren't doing well. Now, it's a dominant strategy in the industry now. It's about to take the baton away from these equity funds, which I say sarcastically struggled last year when the bull market finally came to an end. But you really cannot argue with the multi-manager success now. You know, Citadel not only returned such a sizable portion this year, but last year they also returned 26%. And that's on assets of $60 billion. That is something that a single manager is really unlikely to be able to raise that kind of capital under one single trading style.
So what does this mean? I mean, the rest of the hedge fund industry didn't really do this well, right? It was a losing year for hedge funds in general. What do we think about 2023?
Yeah, there's a lot of other hedge funds that did kind of struggle again in this equity bear market, but this really gives the key that there's going to be further consolidation within the hedge fund industry. It's been a big shift in the last 10 years, even in the last 20 years, away from these flashy single manager names all under one net. You have D.E. Shaw, Millennium, Citadel. They're really gaining a lot of weight in terms of the assets under management that they now run. And these multi-strats have really grown into such a sizable chunk of the hedge fund landscape. And that's one thing that's driven that is the overhead costs due to regulation of launching your own fund. Even if you have the capital, it takes a long time to start to trade. It's way more attractive just to join a multi-manager who already has all these back office, all these trading docs in place.
Okay, thanks very much, Valerie. Valerie Teitel, Bloomberg Markets reporter there with the latest on the hedge fund strategies. And Bloomberg has learned that the hedge fund Elliott Management has taken a multi-billion-dollar stake in software giant Salesforce. The investor is known for seeking board representation and pushing for strategic changes. Joining us for more is Bloomberg tech reporter Aggie Cantrell with the details. So what's the background then, Aggie, on Elliott's stake in Salesforce?
So we've seen Salesforce's valuation plummet since 2021 when the company bought Slack. We've seen that in recent weeks only, the company has said that it's going to have to slash 10% of its workforce, close office space. This is something that we've been seeing across the board for a lot of tech companies. And right now, what Elliott seems to be pursuing is a strategy of making sure that this company is on track for the sort of growth that it thinks it should be doing right now. And so essentially, we are expecting to see Elliott push for potentially similar changes that they've also been pushing for other tech companies that they've taken stakes in, like PayPal and Pinterest.
And given the example Elliott has already set with similar activist positions, should Salesforce be worried?
So when it comes to Salesforce being worried, I think the key point is that we've already seen that this company should be worried by the fact that it has lost 5 of its top executives since the fall of last year. And so now when it comes to Benioff himself, he's seen as quite a strong, steady hand at the company. But we could potentially see changes among the top executives. We could also see Salesforce is pushed to do share buybacks, and also the sort of acquisitions like they did back in 2021 with Slack are unlikely to still be on the cards.
Thanks very much for that, Agatha Cantrell, reporting on tech for us out of Berlin. Now, the Justice Department in the U.S. has found more documents containing classified information at President Biden's home in Delaware. It was actually FBI agents searching the home for more than 12 hours. They are said to have found classified notes from the president's time in the Senate, as well as his vice presidency. Rosalind Matheson, Bloomberg senior executive editor for government, joins us now. So, Roz, we continue to hear about new troves of documents found. Is President Biden taking this seriously?
Well, that is the question. Of course, that one lot of documents is careless. 2, 3, now we're on document search number 4. And what this does, of course, as we see congressional probes start against the US president about this, is really remove any advantage that he had against the Republicans about this as we look forward to the 2024 election. Of course, now he's opened himself to attack from the Republicans, particularly Donald Trump, who says he's running for the Republican nomination in 2024. It's seen not just as careless, but downright sloppy by many people, including his own party, who are now out criticising him, saying, heck, this is the last thing we need to be focusing on right now. We've got real issues in Congress, including with the debt limit, with government debt and so on, and we need to be focusing on that. And now we're going to get distracted by this further. And there's been a sense in some of the comments made by the US president that he's been a little bit cavalier about it, with that comment he made about his car in the garage, saying it was all right because it was locked up. Either way, these were classified documents that should not have been there in the first place.
Roz, good morning. So President Biden is also expected to name a new chief of staff today. What can you tell us about the appointment and its significance?
Well, actually, Joe Biden has been more robust and secure in his staffing, really, than former presidents who tend to cycle through their chiefs of staff quite a bit, even in their first term, let alone their second. So this guy's been around for 2 years, and that's actually a pretty decent stretch. And what we're seeing in terms of the names that are coming, in terms of replacements for him, who might be running his campaign into 2024, is that we're seeing people who have already been in his orbit for many, many years. It's actually quite a consistent group around him. So they're sort of changing seats a bit, but not necessarily bringing in a whole lot of new blood. So it doesn't suggest disunity in his bench. It doesn't necessarily mean that there are problems. It's simply that he's gearing up to look at 2024, seeking re-election, a Congress now where there are key issues around the debt ceiling. You need experts on the economy to deal with that, how to wrangle that new Congress. And it's really about moving the chairs around to deal with that.
All right, Bloomberg's Rosalind Matheson, thank you so much. And we're going to have more on U.S. politics later this hour with Greg Valliere. He is Chief U.S. Policy Strategist at AGF Investments. First, though, let's get back to the markets and take a look at some stocks we are watching in pre-market trading this morning. I want to begin with Wayfair because this was a big mover in the Friday session. The stock rose 20% on the day after the company announced it was cutting 10% of its workforce. On Friday, you saw a number of analysts raising their price target on the stock, and this morning, JP Morgan upgrading it to overweight. So clearly, analysts really like the idea that this company is trying to rein in costs. As a result, Wayfair adding to the gains this morning, up more than 5% before the bell. Another company reportedly cutting jobs is Spotify. This was a Bloomberg report. According to people familiar with the matter, it is unknown the quantity of the eliminations that will be happening, but they could come as early as this week. So Spotify is up a little more than 1% before the bell. Two other stocks to mention as well. You have chip makers upgraded at Barclays, AMD, Advanced Micro Devices, and Qualcomm. The analyst saying he is more positive on semi companies that have data center, PC, and handset exposure. So both of those stocks moving almost 2% higher before the bell, Anna.
Okay, certainly part of our tech focus. Plenty more on tech to come this week, of course, Kailey. Coming up on this programme, Michael Metcalfe joins us, State Street Global Head of Macro Strategy. What is he looking for from the earnings season still to come? We'll also focus on the hawkishness of ECB officials. That's certainly one of the headlines here in Europe. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here in New York at Kailey, Leinz, Anna Edwards with us out of London. Now, if you're listening on Bloomberg Radio, because we are simulcast, you're going to miss a chart that is custom made. Dan Curtis put this together expressly for me this morning. So first of all, I'm honored and touched. Thank you very much, Dan. What it shows is the market, what the market is expecting from the ECB through July, 146 basis points of hikes. The market's only expecting 51 basis points of hikes from the Fed. And because of that, you can see the euro has been on a steady climb here. The reason I love it, I think, is because it's so basic that even I can understand it. Let's bring in someone much more expert than me. Ven Rom joins us, Bloomberg cross-asset strategist. Ven, is this the reason that we see the euro gaining strength of the dollar? Simply the fact that markets expect the ECB to hike more than the Fed?
I think that is one of the crucial reasons definitely underpinning the euro's strength we have seen in the past since the start of the year, and even going back a few weeks earlier than that. Now, look, I mean, the ECB, as you were mentioning, is going to go 150 basis points from all indications, at least the ones that we got over the weekend, 150 basis points by the end of the summer. And the markets are pricing 46 basis points for the Fed. But I do think that they may go 75 basis points if they are going to stick to their dot plot guidance. So twice as much from the ECB as from the Fed. That's the takeaway. And what that means for real rates is that real rate differentials are going to narrow in favor of the euro against the dollar. And that is what is underpinning the euro's ascent.
Yes, and we've seen that euro ascent certainly today and over the past few days then, Ven. How high does it go? How high can the euro go on this particular theme? We're at 109 right now.
I think we are going to go to 114.30, and that's the call that I made at the start of the year with my year ahead outlook, 2023 outlook, MLive outlook for the year. That's the house call, 114.30. I do think that there is a bit of a there's a bit of a scenario where it could overshoot. It could go to 115, 117 thereabouts, but I expect it to pull back to 114.30 ultimately.
Okay, Ven, if we could focus more on the dollar side of that pair and frankly, the Federal Reserve, which it now looks like 25 basis points is going to be the move next week. If the Fed starts cowing to the market, what does that mean for their credibility in the longer term fight against inflation?
Well, that's a great question, Kailey. I mean, they didn't start off against this inflation fight very well. As you know, they kept saying transitory. And then they had a middle period when they did extremely well in terms of signaling to the markets what their intent is and getting there. Now we are getting into the tail end of the game, and now they seem to be vacillating a bit more again. We have heard from Hawker that they're going to go 25 basis points. Now, they've penciled in 525 as the top end of the range, according to the median dot plot that we got in December. Now, nothing really has changed for them to abandon that stance. So if you have penciled in 525, why do you want to drag your feet to get there? It makes sense to get there before the economy goes pear-shaped or wobbly at any rate. And therefore, I don't quite get this dragging of feet at the last minute.
Ven, what do you think happens once the Fed pauses? How long do they pause for? I heard some really different views today. One guest earlier on telling me that they pause and then they start cutting pretty quickly, and then others saying that's not going to happen, that we pause because elevated inflation levels will persist.
I don't think they're going to pause and cut immediately. I think there are two scenarios possible. Pause and stay there for a long time, or pause and take rates higher, if anything, because Fed, inflation is a lot stickier once it's entrenched, and it is deeply entrenched in the US economy at the moment. Yes, it's been coming off. We have seen it come down to 6%, but 6% is not 2%. And getting to 2% is going to be a mighty difficult task. And if inflation stays around 5 to 6% thereabouts, the Fed is not going to be happy, especially in a scenario where we have got some soft landing.
Okay, still some tough stuff to do on inflation then, Ven. Thank you very much. Ven Ram of the Bloomberg Markets Live team. And for more market analysis, check out the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In California, authorities say the suspect in the shooting deaths of at least 10 people at a Los Angeles area ballroom has killed himself. It's believed the suspect tried to carry out a second attack nearby. The killings during Lunar New Year celebrations set a wave of fear through Asian American communities. Meanwhile, China says more than 12,600 people died of COVID in the week before the Lunar New Year holiday. It's likely the real death toll was much higher given the scale of the outbreak. Meanwhile, a top Chinese health official suggested more than 1.1 billion people had been infected since virus controls were dismantled late last year. Poland will ask Germany's permission to send its German-made Leopard tanks to Ukraine. On Sunday, Germany's foreign minister said if Berlin were asked about the tanks, it would not stand in the way. The failure to work out an agreement on tanks has overshadowed pledges to send more military aid to Ukraine. And also, Germany and France are warning that European businesses will have to ramp up spending to compete with the U.S. and China. German Chancellor Olaf Scholz and French President Emmanuel Macron met in Paris on Sunday. They discussed how the EU should respond to President Biden's Inflation Reduction Act. That measure includes roughly $500 billion in spending and tax breaks to benefit U.S. companies. And Spotify is expected to be the next tech company to announce layoffs. Bloomberg's learned that the streaming music giant is planning layoffs as soon as this week. Spotify stock fell 66% last year as investors questioned whether they'd see returns from big investments in podcasting. So if you add Spotify to the list of tech companies that are laying off employees, Matt, they join the ranks of Alphabet, Microsoft, Salesforce, Twitter, Meta, Amazon. It just keeps getting longer.
Yeah, there are a lot of companies laying off workers. And we have a great Bloomberg opinion piece, actually, that shows it may not be the best idea, especially after companies have tried so hard to add workers. It could be bad for profitability going forward, Anna.
Yeah, indeed. How much is this Spotify story about the broader tech trend? How much of it is about the push into, as you mentioned, Kailey, podcasting that they started in 2019? How much of it is about that structural shift and whether they're happy with that? Coming up, we'll get back to the macro stories. Michael Metcalfe, State Street Global Head of Macro Strategy, will be joining the team. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Citadel's record-breaking year. Ken Griffin's hedge fund churned out $16 billion in profit for clients in 2022. That's the most ever. Elliott Investment Management takes advantage of tough times at Salesforce. It's taken an activist stake at the company, hit by job cuts and a plunging stock price. And more classified documents found at President Biden's home in Delaware. That comes after a 12-hour search by FBI agents. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. We'll have more on the politics a little bit later on in the program, Matt. But in terms of the markets, expectations for stocks fading a little as we head towards the open.
Yeah, we have seen futures in the U.S. come down a little bit since the start of this show. We were unchanged about 30 minutes ago, and right now we're looking at a drop of about 0.2% on futures. Of course, this is after the big gains that we had, almost 2% on the S&P 500 in the cash trade on Friday, getting closer to that 4,000 level. Not a lot of movement in terms of the 10-year yields either. Right now, up about 1.5 basis points to 349.33, I should say. So holding steady at that level. NYMEX crude also holding fairly steady, but back up above the $80 level for West Texas Intermediate. 82.05 a barrel is the level there. And then Bitcoin continues to rise, approaching 23,000 right now. We're at 22,923. So not deterred by the bankruptcy at Genesis and back above the level that we saw before the crash of FTX. Kailey, what do you see in terms of the pre-market movers?
Well, I want to pick up on a story that Anna mentioned, which is Elliott taking a multi-billion-dollar activist stake in Salesforce. Salesforce in pre-market trading is up about 3.4% as a result. The idea being that perhaps Elliott is going to push for even more cost cutting and also potentially more share buybacks. Now, other stocks moving higher include a lot of the chip makers. So you have Marvell Technology, which is in the chip space, up about 0.8%, and AMD and Qualcomm each moving higher to the tune of about 2% after they both got upgraded at Barclays. The analyst over there preferring chip stocks that are having exposure to data center, PC, and handset markets. So those two stocks moving together before the bell, Anna.
Kailey, let's have a look at the European equity market space then, and we're pretty flat actually. So as we see US equities fade in terms of the futures picture that Matt just went through, we've got European stocks not going anywhere in a hurry really. We are flat here. This is one underperformer. This is a German chemicals business, Symrise. I picked it out because chemicals is one of the worst performing sectors across the European equity space today. And this stock down by 6%, reporting numbers on Friday after the bell, which showed that the margin was not quite what analysts had been anticipating. And as a result, the stock is being sold. This is the central bank conversation of the moment, really, and here in Europe certainly, and this is around the ECB and how many more outsized hikes will we get from the ECB. Klaus Knot of the Dutch central bank is saying that he thinks at least another 50 basis points will be needed, 50 basis point hikes will be needed. As a result, that's an ongoing pushback against any dovish rhetoric that was in the markets the early part of last week, and so we continue to see the euro gain, and it has gone above 109 for the first time since April, so we'll watch that one. And a lot of the brighter outlook for Europe that is enabling this conversation and this more hawkish rhetoric to come through is to do with what's been going on with, well, the weather. It was milder than expected through much of the winter, and indeed what's been going on with gas prices. So we do have a 63 euros a megawatt hour gas price here in Europe on the European benchmark. It is continuing to fall despite the fact we've gone into a warmer period. It's way below the 340 or so euros a megawatt hour that we had at the height of the crisis in the middle of the summer then, Kailey. But it is a little bit higher than it was at the mid-50s range around the middle of this month.
Yeah, and perhaps that is just adding fuel, if you will, to the ECB's kind of hawkish narrative, they will continue, they say, to have these outsized rate hikes, unlike the Federal Reserve, with official after official now playing up the idea of 25 at their meeting next week. So joining us now to discuss is Michael Metcalfe. He is head of macro strategy at State Street Global Markets. Michael, thank you so much for being here. So we know that the journey may look a little bit less pronounced in terms of the ultimate size of each rate hike at each individual meeting. It is about the destination and, frankly, how long the Fed stays at terminal. Is the market misplacing its optimism if the hikes are smaller, but we still could ultimately stay up there for longer?
Yeah, look, I think that's the big question for 23 so far, is that the market's getting quite excited about the idea that rates go up more slowly, and that means that they then come down quite quickly. And I do worry that the rate cuts priced for the end of this year need a very different set of data, the ones that we're currently getting.
And good morning to you, Michael. And here in Europe, the conversation is also very interesting and slightly different in that we are not talking about that step down yet, or at least the ECB doesn't want us to be talking about any step down from 50 to 25. The message coming loud and clear is that staying the course, as we heard from Christine Lagarde, with these larger hikes as underlined by the Dutch Central Bank.
Yeah, and I think right now central banks are having a bit of a battle with market pricing. And that's particularly true in Europe. But of course, you have to remember that European rates are lower, and the ECB has been playing catch up against the inflation trend really until December. And it was only at that December meeting when they revised their forecast, it was like, actually, now we're worried, you're going to have to listen to us. And I think it's going to take a while for the market to adjust.
And of course, as the European economy gets stronger, and it seems to be stronger than a lot of people had expected through the winter, does that just mean more hiking? We go higher, the terminal rate is pushed out further.
Well, I mean, just as you said in your intro, things like the weather all play into this. I love the line, it's fuel for ECB hawkishness. I mean, it absolutely is. And I think given where their forecasts were in December and the data we've seen since then, the ECB has no option but to remain very hawkish, even though the market seems to be leaning towards a more dovish outcome.
What's your view on the chances of a recession, or how deep a recession we have, Michael? It seems that until last week, we were getting more and more optimistic in our outlook.
Yeah, I mean, I think we've always had the line that a recession was probably a slightly lower probability than some of the market pricing and some of the economists' forecasts. I actually think that the last set of industrial production data in the US did make us actually begin to hesitate on that. But I think the one thing that we can be confident of, particularly in the US, is that if there is a recession, it's going to be very mild, because balance sheets of corporates and in particular consumers are in such good shape. It's almost like the recession will be the opposite of what we had after the GFC, which was a balance sheet-driven recession. Here, the balance sheets are in such a good place that the recession is likely to be mild.
It's, a lot of people had become meteorologists, much like we were virologists a couple of years ago, as the weather got warmer in Europe. I hear it's particularly cold right now in London. Is there any chance that causes havoc again?
Well, so we've sort of been joking as to whether we can forecast financial markets better than we can forecast the weather. And, after the 12 months that we've had, I'll be frank, we're not quite sure. But I can tell you it's very cold right now. And look, I think given the optimism that we've had to start the year, which is great, we didn't have much optimism last year, I think the weather is just one of the uncertainties that we need to play into alongside, the kind of the stubbornness, if you like, of central banks.
Well, and be it because of the weather or other factors, we have seen Europe outperforming the U.S. this year, but there's this kind of growing narrative that maybe we've already seen the gains of the year and that there isn't much more upside from here. What is your outlook on the equity market, both in Europe and the U.S. in particular?
Yeah, I mean, look, I think you have to be careful about how, I think there's a big difference between people's expectations and investors' positions. And so I think, look, everyone's been very downbeat on Europe for a long time. Investors are underweight, it's undervalued, and that isn't going to change overnight. So I think even though we've had a good run recently because maybe people were overly pessimistic on Europe, I wouldn't then flip it to say actually now investors are overweight Europe and there's too much priced in. So I think it takes a while for positions to adjust, even though the kind of the consensus market narrative is that things have gone very well.
And I know it's a Lunar New Year holiday in many parts of Asia, so maybe we're forgiven for not having introduced that theme into the conversation up to this point, Michael. But if you look at actually where profit upgrades are coming from, they're coming fast from Asia, and all of this to do with the China reopening story. How do you factor in that China optimism into your narrative?
Well, so, I think the one thing I would say, we talked about Europe being under-owned and undervalued. That's true for emerging markets and APAC in particular. Times a factor of it's a multiple. So I think actually, right now, if we're concerned about the ECB being a bit more hawkish, the risks of the weather, right now, actually, APAC and EM in particular, might be a better reflation play right now.
Okay, Michael, thank you very much. Michael Metcalfe of State Street's with us to talk global markets. Coming up on the programme, more classified documents found at President Biden's home. We'll get back to US politics. We'll discuss with Greg Valliere, AGF Investments Chief US Policy Strategist. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. Now, the Justice Department has found more classified documents at President Biden's home in Delaware. Actually, it was the FBI that found them in a search lasting more than 12 hours, turning up classified notes from the president's time in the Senate as well as his vice presidency. And the latest discovery escalates Biden's legal and political predicaments ahead of an expected 2024 re-election campaign. Joining us now for more is Greg Valliere, Chief U.S. Policy Strategist at AGF Investments. So, Greg, how serious is this? Is it a real problem for President Biden, or is it just typical that old politicians take classified documents home with them?
No, I think, Matt, this has gone from an annoyance to a really serious crisis. And it's not, ironically, the documents. It's this. These documents were first found on November 2nd. The midterm election was about a week later. Who gave the order to not publicize this, to not go to the National Archives? Somebody delayed disclosing this by a week, and there's a lot of speculation about who that might have been.
So what does this mean for, then, the president's 2024 bid? Will people in his own party even push him out?
Well, it had been a poorly kept secret that a lot of Democrats were lukewarm at best about a second term for him. As everyone points out, if he served a second term, he'd be leaving the White House at the age of 86. He got a lot done. I don't think there's a lot more that he'll have on his agenda. He's got a big fight coming up with the debt ceiling. And I think it's possible that he may decide to drop out. The better chances that he will stay on the ticket. But I also think it's possible there may be a Democrat or two who might be thinking about challenging him in the primaries.
Well, and we know, Greg, that both the Democrats and Republicans are fractious parties at the moment. You have the hard left and the hard right, centrists in the middle. Is there realistically another candidate that could unite the party?
You know what I think would unite the party, Kailey, would be a fresh face. I think more and more Americans are looking for somebody other than Joe Biden or Donald Trump. The Republicans are moving there more quickly. In the last few days, it's clear that Nikki Haley's going to run. Obviously, Ron DeSantis is going to run. There are several other Republicans like Mike Pompeo who might run. On the Democrat side, it's just Joe Biden, who's 80. And I think the Democrats have to be thinking that a fresh face has some real advantages.
All right, and Greg, if we could look a little more near term now, before 2024, we need to get through June and raise the debt ceiling so that the U.S. does not default on its debt, especially as we're talking about fractious parties and Republican hardliners who we have seen have the ability to disrupt the course of the normal democratic process. Is there a greater risk, really, that the U.S. could get closer to the edge of the cliff this time or potentially even take a step off?
Yeah, I don't think a step off, but I think we're going to get very close to the precipice. Very important statement made last week by Mitch McConnell, who has a lot of clout in the Senate. McConnell said, we are not going to default. I thought that was significant. It's going to be difficult in the House. Kevin McCarthy might wind up losing his job, but I think in the end, it'll get done at the very last moment.
Yes, I wonder what is the role of McCarthy, given the precariousness of his position, Greg?
Well, he's obviously a fairly moderate Republican, and he has priorities like defense spending, like aid to Ukraine. There are things that he feels have to get done, and he, I think, takes seriously the U.S. pledge to honor our commitments. So I think McCarthy will be a big player. The Senate won't be the problem. Again, it'll be the House.
What kind of arguments do you think will bring round those Republicans who really want to take this to the edge and test the financial markets on the debt ceiling? Are there any arguments that can be used, like the ones you've just put out that we've heard from McConnell and others, that would persuade them to take any different kind of tack here?
Yeah, I think there'll be a lot of adults in the room, not just McConnell. I think that Jerome Powell may get very vocal in saying this is crazy, we can't do that. I think the Republicans in the House have to look at the polls. And I would guess that by midsummer, the polls are going to show the American public feels this is madness, and especially if there's a growing fear that going off the cliff could hurt the economy.
It does seem that we have this every once in a while. And I recall distinctly, Greg, the last time we had a ratings downgrade, investors flocked to treasuries, so it didn't hurt the economy.
That's right. And there's one other common theme in all of these near misses that we've had, and that is that things wind up more fiscally hawkish, more restrained. And I think whatever deal there'll be, and there's going to have to be a deal, I think will cut back on spending, which has been the pattern of these fights in the past.
How do these things usually play out in the court of public opinion, Greg? I mean, would edging close to the precipice of default play out worse for Republicans if they're the one holding up raising it, or is it ultimately the president who feels it?
Usually the Republicans lose the PR battle. They have a long history of self-inflicted wounds on this subject, and I think it will happen again. But in order to get to a public backlash, you probably have to have a very volatile market. And I think volatile markets are going to be a feature of 2023.
Okay, so we might see that then. Greg, thank you very much. Greg Valliere, Chief U.S. Policy Strategist at AGF Investments, with thoughts on U.S. politics. Coming up on Balance of Power, sticking with the political theme, former U.S. Ambassador to NATO, Kay Bailey Hutchison. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now let's take a look at what's coming up for the rest of this week. Tomorrow, we'll get earnings from Microsoft. Consensus sees second quarter revenue growing at the slowest pace in 6 years. And of course, the tech giant recently announced another wave of job cuts. Then on Wednesday, more big tech reporting. Tesla will be giving its fourth quarter results after the closing bell, after recently announcing price cuts across many of its markets. Then on Thursday, a lot of eco data out of the U.S., including GDP and retail inventories. Plus, the energy branch of the French Union also starts a 48-hour strike on Thursday in opposition to President Emmanuel Macron's controversial pension reforms, Matt.
All right, we'll continue to watch what's going on there. And speaking of the French, over the weekend, the President Emmanuel Macron, as well as German Chancellor Olaf Scholz, met in Paris, continuing the push back against the U.S. Inflation Reduction Act.
Es ist notwendig, dass wir
It is necessary that we handle the inflation reduction aid and formulate a European answer. Firstly, we have to make sure that, as a European Union, we are not treated worse than neighboring countries such as Canada or Mexico. And it cannot be accepted that the many local content regulations that are in there cause discrimination of European businesses and their activities in the U.S.
Unternehmen bei ihren Tätigkeiten und Aktivitäten in den USA bedeuten.
Joining us now is Bloomberg's Western Europe government editor, Richard Bravo. So, Richard, why are European leaders so worried about the U.S. Inflation Reduction Act? Do they not think that the U.S. is really going to come to the table and change things?
Hi, Matt. Yeah, so I mean, it's important to keep in mind that the point of the IRA is to help the U.S. finance the green transition. And broadly speaking, this is a concept that Europeans support wholeheartedly. What they argue with is that they feel that the way the law has been created unfairly subsidizes American companies. And as a result, European companies will be at a structural disadvantage and they won't be able to compete with their American counterparts. They also feel that because the U.S. is giving so many subsidies to American companies, it will actually entice European companies to relocate to the U.S. from Europe. And this is obviously something that has caused quite a lot of concern on the continent.
Yes. So whilst European leaders might want to see more investments in green technology, they don't want to necessarily be excluded from that, and they don't want anything that looks like protectionism. Another issue that was discussed by European leaders a lot last week and will be no doubt discussed at the European foreign ministers meeting today where you are, Richard, is around the supply of tanks, either by Germany or Germany allowing others to supply tanks to Ukraine. Where have we got to on that?
So this is a very complicated issue, and it's basically started because Ukraine has asked for the supply of heavy battle tanks, especially before the spring when many people expect there to be a new offensive. Now, Germany has a heavy battle tank called the Leopard, and in order for other countries to re-export their stock of Leopards to Ukraine, Germany has to give approval, since all of these tanks were made in Germany. And Chancellor Olaf Scholz won't do this, and there are a few different reasons why he doesn't want to give this okay. Partially, he doesn't want to escalate things with Putin. He also says he wants to build a coalition of countries to come on board and do this as more of a joint venture. But criticism is mounting among countries. Poland has been very vociferous in calling for Germany to greenlight the supply of these tanks to Ukraine, as has Estonia. And the U.S. has also called for Germany to allow these tanks to be sent to Ukraine.
Richard, thanks very much. Bloomberg's Richard Bravo in Brussels, continuing to monitor that story. And it's one we'll continue to watch then, Matt, as it seems that various voices within Europe giving slightly different messages about this at the moment as to whether Germany will stand in the way of other European countries if they want to give their tanks.
Yeah, it's really interesting to see Germany blocking this. Of course, they have a history of being, well, you know, since the Second World War against these kinds of, against any kind of violence and pushing for peace. But they also have a history of supporting Russia, and that's what paints them really, I think, in a bad light, since they've been so reliant on Russian gas.
We will focus back on the markets in the next hour, though. This is it for Early Edition. Surveillance is ahead with Tom, John and Lisa. They'll be hearing from Margie Patel of Allspring Global Investments, among other voices. Plenty more still to come on the markets. This is Bloomberg.